I've been investing for around 10 years now, and while I have made some money, I also have made some mistakes. Few that did just slow me down, but some that actually cost me money. Today, I'll share the 5 biggest mistakes I wish I'd avoided when I started, so you don't have to go through that learning curve as well. Mistake number 1: waiting too long to start. I used to think I needed thousands to invest, so I waited. But time, not money, is the most powerful tool you have when investing. Even $5 a day, if you start right now, is going to be worth more in the long run than $10 a day starting 5 years from now. I missed out on so much compound growth by just delaying. Here you can see a comparison between the two. This one is $5 a day. That's right around $150 per month versus $300 per month, which is in the next graphic right here, just to compare the two. My advice on this matter is just start as soon as you can. Whatever money you can set aside, be it $5 a day, be it $5 a week, whatever is good for you, whatever is right for you, start setting that aside. This will help you so much. The most powerful tool, as I've mentioned before, the most powerful tool you have when investing is time. And time you cannot get back. The money you can always get back. You can always cut back on something, but you'll never have more time than you have today. The younger you start, the better for you. The difference you can get with 30 years of investing versus 40 years of investing is huge. Just look at Warren Buffett. Warren Buffett is so rich just because he has been investing since he was 13. Now he's like, what, 120? And 90% of what he's made in the past few years, actually. Because of compound interest. The more time the money sits on the market, the more it will value. So mistake number 2, copying portfolios without understanding what is inside. When I finally started, I just copied a popular portfolio I had found online. It looked legit until I realized I had no idea what I owned or why. Investing isn't a one-size-fits-all. What works for someone chasing fast gains won't necessarily work for someone looking at long-term stability, for example. Here's a tip. Align your investments with your goals, with your risk tolerance, and with your timeline. That is the smart way to invest, not just copying whatever works for someone else. They could be wrong, and even if they're not wrong, their goals and information could be different to yours. Mistake number 3, playing it too safe too early. I went super conservative. Bonds, stable ETFs, even cash-heavy allocations. And while safety is great, don't get me wrong, I love safety and I preach safety to everyone that starts investing. Well, I was 20. I could have risked a bit more. When you're that young, you can afford to take a bigger risk and let time do its work a bit more. Now I know, when you're young, you can be more aggressive because you have more time to recover. And over the long run, you will probably be fine anyway. Just give it more time since, well, you have it. That's your biggest advantage here. That's something I will never have again. And only you, if you're younger than me, of course, will ever have. Use that. Use that to your advantage. It's the biggest advantage you can have on the stock market. Mistake number 4, chasing short-term gains. I went through a phase where I was obsessed with quick wins. I checked my portfolio every day, bought stocks that were trending, hoping they'd pop. Sometimes they did, but most of the time, I got burned. Short-term thinking led me to make emotional decisions. And emotional investing is almost always a bad idea. So here's my tip for you. Just zoom out. Take a look at decades, not years. Or at least years, not months, and you will sleep way better. I actually had a friend ask me this today. I was talking with him about investing and what exactly is stopping him from investing. In short, his answer was he doesn't know how to invest and he wouldn't even know when to take the money out, which I found funny. I found that quite interesting, really. Because I think that's the wrong mentality to have. In my eyes, the real answer, when should I take my money out, is never. Or whenever you need it for something. Sure, if there's a need, if there's something, if you're aiming for a certain amount and you're hoping, I don't know, you want to buy your kid a house in 20 years, fine. That's fair. You can take it out then and that's okay. But unless there's that, unless there's something very specific you want to do, you never really need to take it out. Here's my ideal scenario of the future. I invest, I let it grow, and in 20 to 30 years, I will have enough money in there to retire. But not just that. I will have enough money in there to never pull it out. I will have enough money in there so that 4 to 5% of the yearly growth of that portfolio will be enough for me to take out and live off of. and the rest 3, 4, 5% I would get every year just stays in there and compounds further. So let's say you have $1 million at one point in your investments. 4% of that is $40,000. For me, in my country at least, you can live very comfortably off of 40,000. For you, it might not be the case, but for us, that would be a great yearly income to have, way above average. So if I had $1 million in an investment account, instead of taking it all out and spending it, I would just take 40,000 out each year and let the rest compound and grow over time. And by the time I leave it to my kids will have a portfolio of 1.5 million, and they'll be younger and they can keep doing the same exercise, creating generational wealth in time. Now, this plan may not work for you specifically, and that's fine. We all have different goals and different ways we want to view this. This is why this is an interesting topic to cover. There's so many things you can do and so many approaches you can have. The important thing is make this work for you. Make it work for your goals and your ambitions, and you will succeed in time. Just let it happen. And finally, mistake number 5. Thinking diversification means owning everything. I thought having a ton of stocks meant I was diversified, but I was just collecting random assets. I own stocks from 20 plus companies, and to be honest, I couldn't tell you what half of them did. That's not diversification, that's just confusion. My solution? If you're passive, get a broad ETF like the S&P 500. If you're more active, then fine, go ahead, invest in as many, but know what you own, know what you're getting into, and most importantly, and this is the biggest tip that anyone can ever give you regarding the stock market, only invest in companies you truly believe. Invest in companies you think will be here in 20 to 30 years and you think will thrive. Everyone makes mistakes when they start, but you could avoid at least these 5. And if you can avoid at least one of these, you'll be in a way better spot than I was 10 years ago. If you're ready to actually start investing, even with as little as $5 a week, I made a full video on just how to do that. Click right here to see it. Start small, start smart, and most importantly, just start.